yeah, how you guys doing today? Welcome to Blockbytes. Actually, wait, let me do the intro. Welcome to Blockbytes. Thanks for joining us today. We have Greg from M0 Labs. Greg, what does the carrot mean? Let's get right into it. What is
Okay,
the
good
carrot? How do I
question.
read it?
M to the power of zero. So,
Ooh.
we are a stablecoin crypto dollar project. Anything to the power of zero is one.
Mm-hmm.
It's exactly the kind of stability we're going for.
Oh, that's beautiful.
Yeah, very
That's a great
geeky.
name.
I like it.
Yeah, not a lot of people put that much thought into the name. Some are just called Pancake.
Well, so this is a
Not to
kind
throw
of
shade.
a funny story. So for the first 6 months of our existence, we were called the thing. I kid you not. I mean, like our legal documents, even today, are called the thing.
Whoa, like the Fantastic Four.
Because we had no idea what to call it. We're like, we're going to figure that out later. And
That's
there was an inflection point where we had to decide, like, do we want to pick a real name or do we just call it the thing? And so we were very close to just still today, like you might have seen Greg from the thing.
I think it could work actually because it's like silly enough to actually work.
Yeah, but then one day I think it was my co-founder Luca came up with M0 because we were thinking like we're a stable coin, we want to be like the base money supply, so M0, and then we thought of the power and the M to the power of zero because M to the power of zero equals one.
Yeah. I mean, it makes perfect sense for what you guys are doing. So that was like a brilliant strike of, what do you call that? Serendipity. What a serendipitous moment he experienced. And what a jump from the thing.
Yes.
I feel like I've seen a brand out there that was just called Thing or something like that. But I mean, it's a good thing you guys changed because obviously I forgot them, so it didn't have a lot of staying power.
Yeah, I feel like especially in English, just thing doesn't really flow.
Yeah, the stuff.
Yeah,
Um,
maybe if you sold flip-flops or something, you could call it thing. I don't know.
yeah, it actually makes sense for flip flops, little knickknacks like that. But all right, now let's aside from the name, Greg, let's actually get to know you a little bit. Uh, how'd you get into this space? Who are you, Greg? Pull back the curtain, dude.
We have a long time because if you could tell by the bags under my eyes, I've been here a while. So I got into Bitcoin in 2010 just as an enthusiast,
Mhm.
and that's how I fell down the crypto rabbit hole. I was on libertarian internet forums, and we were very convinced that Bitcoin was going to immediately replace the dollar, which wasn't that crazy back then because that was like in the wake of the financial crisis, and
Mhm.
it did actually seem like everything might collapse, but yeah, that didn't happen. And then I went on to a career in finance. I was a commodity futures trader. And I don't know if you guys know anything about trading, but it's a lot of doing nothing. So
Mhm. A
you're
lot of
kind of
waiting.
sitting there almost holding your hand back from clicking the button because you don't want to make a stupid trade. So during those first years of my career, I would just go on crypto forums and I would research the new stuff coming out. I remember, I think it was like maybe 2013 or something, like BitShares was just getting going. It was 2014. And I got into that community. And then the Ethereum white paper dropped. And I thought it was like the biggest bunch of nonsense I ever read. I'm like, these guys are scammers or something. And then a year later, they launched Frontier, which is the mainnet. And I'm like, now I get it. So I didn't want to make the same mistake of under investing in it as I did with Bitcoin 5 years earlier. So I went to my boss at the time and I was like, we should get into this thing. So we did. And then he fell down the rabbit hole. And that's when in 2016, we decided to start the first Ethereum ETF here in the United States. Now, if you've only recently seen headlines about an Ethereum ETF, you know that we did not get approved for our ETF for quite a
Yeah.
while. We never did. We actually pulled the application like 2 years ago because now we're competing against BlackRock and
Yeah.
we missed the first few $100 billion of TVL, but or AUM as we used to call it. But it was a good. I'll use your word, serendipitous decision because it got us full time into the space. We left the trading desk and we started one of the first crypto VCs called Distributed Capital. And we were just a specialist that was structured to hold ERC20 tokens, which at the time it was like a lot of funds wanted to get into the space. They couldn't because they weren't appropriately structured. So we swept in there and were made sure that we could actually hold the ERC20s. Of course, at the time, there were only 5 ERC20 tokens. So we basically only had 5 things to invest in, and our core portfolio investment was MakerDAO. So we bought some MKR, we had a bunch of ETH, Bitcoin, etc. But then we realized shortly after buying all that MKR that Maker was still kind of more of a vision than an actual product. So we started consulting for the team, and we ended up helping them build entities. We helped them get bank accounts. And about a year later, we had caught that first like really stupid bull market in all the ETH tokens. And we're like, our TradFi investors are just never going to understand or stick through a bear market in this space. So why don't we cash them out? And we love Maker. We're totally bought into the vision. Let's join that team full time. So we did that. I came on as Maker's head of business development about a month before we launched DAI in the first place. My business partner came on as their head of trading and markets. And for the next 4.5 years, we built MakerDAO. Fast forward to 2021, Maker Foundation winds down because the protocol is sufficiently decentralized. And we start 2 new projects. One is called Ajna. That's a permissionless lending market. It's on mainnet today. And the other was RWA Co., which was helping commercial banks onboard into MakerDAO for institutional credit lines. And this is where the seeds of M0 started to develop, because I met my other co-founders here because they were also working in the Maker ecosystem trying to do these institutional deals. And we realized, together, this was not going to scale. It's just very, very hard to fit this round peg in this, or it's a square peg in this round hole. So we said, well, Maker needs something to do here. And the world needs something where we start to connect these institutions to the blockchain. And that's where we said, let's build M0. We have all the pieces together here. And just to give you the elevator pitch of M0, M0 is a coordination layer. It's a decentralized protocol where institutions can come with eligible collateral, which in our case is short-term T-bills, and they can pledge those T-bills to the network in order to generate a common fungible crypto dollar, or stable coin, if you like to call it that. And then that stable coin gets pushed onto the market and pays yield to eligible earners.
So can you explain a little bit what is your role now, and like what is your day-to-day look like working for M0?
So I'm one of the co-founders, and my title was chief architect because I kind of designed the governance apparatus and the protocol. And I worked very closely with the Solidity engineers to then implement it. And now my day-to-day is I spend about half my time working on new technical features. So like we just launched yesterday, actually, our smart wrapper, which is like a totally new way of integrating a stablecoin into DeFi. And on the other side, I spend about half my time doing business development because, as I mentioned, I did biz dev. I led the biz dev team for MakerDAO for 4.5 years. I have a lot of comfort in that area, and I have a good network. So I am very fortunate. I get to split my time doing 2 things that I like.
You've had that's a really long and fun career to have been a part of, or to have led, because
you think I'd be retired by now, right?
Dude, well, I mean, with crypto, right? With what everyone on Twitter is telling me with crypto, I got to be retired in like a week or I'm not doing it right. Because you're in there in like the OG forums, dude, like the really old ones, that's really quite fun that you kind of made that transition almost along with the industry. It's almost like, Greg, it's almost like when you stepped in, we started professionalizing, dude. So that's really cool, though. Could you tell me a little about the smart wrapper, though? You just said a smart wrapper is a new way for them to interface with DeFi.
Yeah, we're really excited about this. So I don't know how familiar you and your listeners are with the way that various wrappers work in the ecosystem. It sounds like a benign technicality, but actually it really matters for the integrations. So if you were thinking about, let's use a Uniswap pool as an example, right? You open a Uniswap pool of ETH to USDC. Now, USDC does not pay any yield to the user, so you're good. You just make the Uniswap pool. The USDC is always going to be 1, and you never have to worry about shifting your bids and offers because of a changing denominator. Like the denominator is just always $1. Now, if you want to pay yield to your users, which we think is inevitable and a good thing, you need to somehow figure out how to pass them that yield on chain. And other stablecoins like DAI have their savings version. So SDAI is Maker's wrapped DAI that earns yield. But it's very hard to implement this, especially when integrating with DeFi, because DeFi integrations don't know how to handle changing balances. So if I put in ETH to DAI, and then the denominator DAI is increasing in value, I have a problem. Because one, if I just airdrop more DAI into that pool, it's going to get stuck in the Uniswap pool and you can't take it out. Because Uniswap contracts are immutable, they can't call external methods. Like when you deposit into Uniswap, it fixes your balance. So what Maker did to get around that, and what other stablecoins like Mountain and even like something like Steth, right, like staked ETH, they all have this. I call them V1 wrappers, where they just have an exchange rate. So you have one Steth today, one SDAI today, and maybe it starts being worth one DAI or one staked ETH, but in the future it just goes up. So your one token is always one token for the purpose of the integration, but the value of that token is increasing. But now you have a problem because that breaks the economics of the integration. So in the Uniswap pool, now you have to bake in implicit deflation to your bids and offers. So your denominator token is increasing in value. It's no longer one. So now when you're trading ETH to SDAI, it's no longer the price of ETH in dollars. It's the price of ETH in SDAI, which has a completely different exchange rate. Or if you're doing a lending market and you're lending Steth out, you're no longer just borrowing ETH. You're now borrowing a token that's increasing in value, meaning you have to bake that interest rate into your other interest rate. And it adds all sorts of exponential complexity to DeFi that makes it very hard to use. So what we did was we built what we call our smart wrapper. It always keeps a 1-to-1 exchange rate. So one wrapped M, or one smart M as we have to call it, is always one M, and you can always redeem it for that. But if you are on our earner list, you get to provide an address where the yield will flow to external to the contract. So let's use a Uniswap example. We have ETH to M. So the denominator is always $1. So we're just looking at the dollar price of ETH for trading purposes. But the pool itself is earning yield on all of the M that's sitting inside of it. And governance gets to reroute that yield to a separate contract, which then has arbitrary logic that can pass the yield back to the LPs as it sees fit. So it gives the integrator an entirely new way of distributing yield from their stablecoin integrations, where right now it's just like it's doing it in the most simple way possible, where it just passes it to the holders of the token and it uses deflation, which breaks the integration.
Oh, very cool. Yeah, we're familiar with that. The problems of wrap tokens and also rebasing in DeFi is a pretty big problem. And I think for an LP that's very risk off, they don't want to take these risks. So I haven't seen that before. Do you think it will become sort of like a new standard in DeFi?
I hope so. I mean, I think everyone's going to copy us because like I said, we're very proud of it. We think it's a really good idea. We did somewhat prohibitively license it because we don't want our competitors to immediately be able to copy it. But if somebody like Staked ETH wanted to use it, I think they can easily get us to license it to them.
Wow, that's really interesting. So is this going to be one of the things I've always heard about these kind of like wrapped tokens like that accrue interest is they're kind of like very destabilizing, or they have the potential to be extremely destabilizing if anything were to happen economically, any kind of rapid shifts. So would this like improve the stability of the systems? I'm kind of a dumb guy, so I may not have fully grasped the implications, but this sounds like a really big step forward, like Ulver was saying, the rebasing issue.
Yeah, well, so M is actually rebasing natively. If you're building a new DeFi protocol and you build it to handle rebasing assets, you don't need the wrapper. You could just integrate M. But the wrapper is for all the existing DeFi protocols. And like you said, you no longer need to worry about an exchange rate inside of your exchange rate. So now one wrapped M is always one M. That is just going to be a permanent relationship. So you never have to worry about there being less M or more M than you put into the wrapper when you take it out. All of the yield is routed completely outside of the contract and put wherever you want it to go.
I see. Okay. Wow. Okay. That's a big step forward, dude. That's pretty cool. Awesome.
Yeah. Put a lot of time and audit money into it. So I hope it's worth it.
Yeah. Where are you? Is this going to be implemented just with Maker right now in like the Maker ecosystem, or like do you have any partners already set up that are going to be licensing it off the bat?
No, so we're completely separate from MakerDAO. We're a totally different protocol, totally different stablecoin. We hope one day that Maker will adopt our product because we think it's a lot better for them than holding something like USDC. But if they were to adopt it, they could use the wrapper, and then they could have the yield be distributed however they see fit to their users.
Okay, cool. Let's see here. We've got a list of questions here, but we kind of jumped all over here.
Well, I can jump in. What do you think are like the key components of the protocol? Like what is it that makes it work?
That's another long one. So we really designed this from the ground up, from first principles, to be the best dollar approximate on chain. One of our major philosophical points of the design is that people don't want money, they want dollars. And this is like, think outside of the crypto space. Like forget our little crypto degen circle for a second. What does the average person that's holding money really want? And then take yourself back in time, like 50 years. When you were holding cash, what were you holding? Was it a bank deposit?
No.
Exactly. It was cash, right? And that cash was always worth what it said on it, and it had zero counterparty risk. Now, it had some drawbacks. You can't transfer it across a border very easily. You can't, pay on the internet with it. But it did have a lot of really nice properties that we've lost by replacing it with bank deposits, because bank deposits were never meant to be used as cash. And if you think about what a dollar really is, a bank deposit is a very poor approximation of a dollar. It's a fraction of a claim on a dollar. And a real dollar is only two things: an account at the Fed, which you can only get if you're a commercial bank, or a physical dollar bill that you have in your wallet. So we said, let's take our design and try to make it so we can give people the closest thing. They can't get an actual dollar because those two things you can't put those on a blockchain. But let's give them the closest approximation of a dollar that has all of the benefits of a commercial bank deposit in terms of like the digitization and the ability to transfer it instantly, which you get from the blockchain, but also minimizes the counterparty risk. So it's not really a fractional claim at a dollar. Maybe it's just a step removed from a direct claim at a dollar. And the way that we solved that was we said, the only collateral we're willing to accept for this are short-term T-bills, because a short-term T-bill will always deliver you dollars when it matures.
Okay, so the difference, like if you have a bank deposit, then if the bank goes under, if there's a bank run, then, oh, whoops, the money's gone. And that's why you want cash, because, it would be harder for you to lose the cash somehow or someone to take it from you.
So the bank, this is the essence of fractional reserve banking. The bank has a certain number of reserves at the Fed, and those are actual dollars, and it issues you a depository note, which is a claim on a fraction of those reserves, because they need to make loans, otherwise they don't make any money. So the great example of this is if you look what happened to USDC when the SVB debacle happened. USDC immediately went to 90 cents, and that was not the wrong thing to do, because if the Fed did not bail out SVB, USDC was worth 90 cents because they were not getting that money back.
Mm-hmm. All right. But how is this different with your system? Because with this short-term treasury bill, it's still custodied in a bank, right? So could that bank go down, or like how does that work, and what's the difference?
It's not a bank deposit. So the way our system works is we make sure that our issuers come to the protocol with the full setup. So they have to have an SPV in an approved jurisdiction that is completely orphaned, meaning it has no ownership. It is completely bankruptcy remote, meaning that its parent company not parent company, its affiliate company, like the issuer, cannot pull it into a bankruptcy proceeding. And it keeps those T-bills with a approved custodian. And the custodian has a segregated funds account. It's not a deposit. So you're not commingled with the rest of the risk of the bank. So really, you are getting as close as possible to just having a direct claim on those T-bills. Even though as a holder of M, you don't have a claim on T-bills, but the minter always has access to those T-bills. So they're completely siloed off, and what we envisioned is the most secure collateral storage facility that we could design. And they're between 0 and 90 days of maturity. And if they do mature and they turn into bank deposits, we subtract that value from the minter's balance. So we don't let them count that as collateral.
Okay, so you're basically cutting out like a middleman and de-risking this sort of like banking layer, and almost getting like a direct access to the Fed, because they, maybe you can own directly at the Fed, but with this, it's kind of like the closest thing to having that. Is that right?
Yeah, our pitch is like, if you think about who's going to get screwed over last in this fractional reserve system, it's the U.S. government. So we'll lend to them very short term, and they will almost always deliver us those dollars if those T-bills mature.
Interesting. I'm trying to wrap my mind around. So like the margins had to be very tight then, right? Like if you have these really short-term T-bills, and you still have to pay for the custodianship, right? In this segregated account, and if they're not lending it out to like a fractional lending basis, are they just consuming a bit of that interest off of the T-bill?
Yeah, so this is maybe where we should talk about what M0 actually is. So we're not a stablecoin issuer. We are a
Okay.
coordination layer for holders of this collateral to meet people who want to hold money. And that's an important distinction. Like if you think, and this is very much based off the original design of MakerDAO. If you look back at Maker V1, people brought ETH to the protocol, they locked it in a vault, and they were able to generate DAI against it. And the reason this was so powerful is that it brought your cost of capital down to the price of liquidity. You didn't need to make a margin. So people with ETH that needed liquidity, they would come to the protocol, and you could charge them 0, and the whole thing still would work in certain environments because they needed that liquidity. And on the other side, people needed currency to use in the blockchain. Most stablecoin issuers today do exactly what you just said. They live and die based on their net interest margin. So they need to have collateral that they keep in their vaults, and they issue a stablecoin against it, and they make the difference of what they pay their customers versus what they earn on the collateral. Our network is a little bit different. So our network is multi-issuer. Anybody that has eligible collateral and can get approved by governance can issue M. So we open up the door to every institution to come and use M0 as a facility. The difference here is that now there's a liquidity component, not just a net interest margin component. So even if we're paying out the full risk-free rate to the M holders, there's still a reason for minters to come to this network, because maybe they're just holding T-bills, and instead of using a repo desk, they'd rather get liquidity through M0. I think we're the only network that could actually survive 0% interest rates because we have this liquidity layer, not just surviving off net interest margin.
All right. So basically, the choice is like they could hold a T-bill, but then it's kind of like locked up and not doing much, or they could like mint the stable coin, and then it's sort of like they're holding a T-bill, but they can also use it in DeFi, so it's more liquid. Is that what you're saying?
Sort of. So imagine, like the example I like to use in, let's say, 10 years in the future, we're very successful. There's huge, deep liquid M markets all over the world. Japanese life insurance companies sitting on $100 billion of T-bills, and they need liquidity to go make payments or make other investments, etc. Today, they'd have to go to a repo desk. They would do a repurchase agreement with those T-bills, and they'd get dollars, and they'd go use those dollars. M0 is kind of like a giant global repo desk in that capacity. They pledge the T-bills to an SPV, they become a minter, and they can generate M, and then they sell that M for dollars to people who want to hold currency. And they go do the same thing with those dollars that they would have done with the loan they got from the repo desk. So it really just acts like a repo loan, because when they want to repay it, they take the dollars, they repurchase M, they pay it back, and then they can unlock their T-bills.
All right. So it's like further, I guess, decentralizing the issuance of these stable coins. Maybe we can talk about the different roles in the protocol, like there's minters, earners, and validators. So could you explain what those are and like why are they needed?
Yes. So let's just define all of them first, and then I'll talk about how they work together. So minters are the ones that generate M, and M is the crypto dollar or stable coin of our network. They are doing it, as I said, either because they want liquidity or because they want to earn the spread between what they're making on T-bills versus what they're paying to the network. Validators are the ones that are the bridge between the real world and the blockchain. They ensure that the collateral is there, and they ensure that it is worth what the minter is saying it is. And then finally, earners are distributors of M. So if you are an application or a business that is using M and distributing it, you can apply through governance to be on the earner list, and then you will earn the T-bill rate on your M, or higher if you're distributing M in such a way that it lets you do that. So the way they work together, we are trying to be the most transparent system. Like we think that we can cut through all of the BS in this in the financial landscape with transparency. So the way it works is a minter comes to the system, they get permission, they put the T-bills in the SPV. Now they need to generate an on-chain transaction that ports their collateral balance on-chain so that the system knows what it's worth. So what they do is they look in their SPV and they say, I have $1 billion of T-bills. And they're structured correctly, they're in the right entity, et cetera, et cetera. They put a transaction on-chain that's called update collateral, and they put $1 billion. They now cannot actually submit that transaction unless they have the signature of one or more validators. And how many validators you need is a protocol governance parameter. So let's say we say they need 3 validator signatures to do this. They can't update that collateral balance without 3 validator signatures. And now, on at least right now, it's every 30 hours, so basically a daily basis, they need to update that collateral again. So I'm pretty sure we are the only system that's doing this constant real-time attestation to the composition, presence, and value of the collateral. And then earners, once they're on the earner list, they earn the interest rate. So those are the 3 actors.
All right, cool. And how are the validators paid, and what's their incentive to take part in this?
They make a deal with the minters. So the minters are earning income or, using the system in such a way that it's beneficial to them. And then everything kind of flows from there. So they need to contract validators if they want to use the system, and they need to pay the validators. And that's between them. We don't get involved there.
Is there any potential for, I guess, if the relationship is between the validators and what are the 3 parties again? Validators, minters, and
earners.
Earners. Okay, so yeah, the validators and the minters. What's to stop collusion then if they're working together? If I have to contract.
Great question. So that's why we have 2 ways to combat this. One is a protection before the collateral balance gets updated, and one is after. So the one before is that, like I said, we control how many validator signatures you need. So if it's just one, it's easier to collude with one party to get an incorrect balance on chain. If it's 2, now your cost of collusion starts to go up linearly with the number of validators that we assign. And the idea is that eventually, once our ecosystem is built out, we're going to require a lot of validators who will just not really have any incentive to collude because they'll be surfacing multiple minters to sign off on each transaction. And then on the other hand, we have an optimistic approach where we say, anytime somebody tries to mint M or generate M, there is I think right now it's set to a couple hours, but there's a period of time where any validator in the system can cancel that transaction. So they can only mint one at a time. And if they do it and any validator sees something wrong with the transaction, they could just cancel it. There's no penalties for doing it. And then it's the minter's responsibility to convince every validator in the network that their mints are genuine. So we have 2 approaches. One is the validator signature threshold. The other is this cancellation. We also have a freeze function where if a minter is repeatedly abusing their role, a validator could just freeze them for a day and then basically force it to governance to offboard them.
And I believe we still have to cover the earners, right? Because I'm going to make a note. I have a question about governance next, but let's go cover the earners.
So earners are, this is actually more about our go-to-market than anything else. Most other yield-bearing stablecoins, they just pay everybody that's holding the stablecoin. If you look at SDI, anybody holding SDI gets the interest rate. Anybody holding USDM gets the interest rate. We don't think that is the most efficient way to distribute. We the way we look at the world is we break it down into distributors of stablecoins, issuers, and users. And today, that relationship is very broken because you have the issuers not paying distributors who are then paying users. So you have exchanges distributing Tether to the whole world for free. On the other hand, they have to, pay a lot of money to acquire users and run their business. So we say, we are going to permission that exchange to be on our earner list, and all of the M on their exchange, they are going to earn interest on. And then what they do with that is up to them. They could use it to subsidize their user acquisition costs. They could keep it as profit, etc. But on the other side, if they become big enough and they become a major distributor of M, they can always become a minter and recapture those back-end economics. Because today, the way it works is they distribute, let's use Tether as an example, just because it's the big one. They distribute Tether, they help Tether become a juggernaut, and then there's actually a conflict that develops here, because now Tether is disincentivized to pay them. Tether says, no, you already made me big. I don't need to pay you anything. Thank you, but please keep distributing USDT. Whereas if that happens in M0, the protocol can't go to them, well, we can say, yeah, we're going to cut the earner rate, we're going to lower what we pay you, but you can always then become a minter yourself and recapture all of that economics. So we always allow our distributors to sit on both sides of the aisle so that they never have to worry about getting boxed out of the economics that they help to create.
Fascinating. Okay. So that allows the relationship to remain kind of dynamic and them invested in it at any stage. Are we seeing any of that issue with Tether at the moment, where it kind of is like ballooned out and exchanges are experiencing this conflict with the Tether?
I think everyone is. Exchanges, market makers, I mean, they use it because it's the most liquid and there's tons of it, but they have basically built Tether for them. Like Tether doesn't distribute USDT to anybody. Tether has a few selective market making relationships, and then everybody else does that job for free. So, yeah. And they give all of those economics right back to Tether. That's why Tether is one of the most profitable companies in the world.
Yeah, I remember that always being one of the criticisms about it is no one knows. When I first got into crypto, it was like no one knows how you even actually get Tether, like from the source. But it was because they just have a few market making.
What it's backed by. We later learned that it was backed by an unsecured loan to Bitfinex. But now there's allegedly T-bills, so we're told.
Yeah, T-bills and gold from what I've heard. And M sounds very interesting, and it seems like you guys have governance kind of already built out. I'm kind of fascinated by governance personally. Because it seems to has like such a wide range of effectiveness across its implementations. And you mentioned actually like in your career at a point you were building out, I believe, Maker's governance early as well. M's governance, can you kind of explain how it works a little bit? Is it just a basic, like what is the governance token and kind of like how does it work? Like, is everyone just making purple?
Yeah, I didn't build Maker's governance. I was a user of Maker's governance for quite a bit of time, which I'd wished I built it at that point. Maker's governance was like the first attempt at this, right? And I think we took a lot of the lessons that we learned there and what we didn't like and tried to fix it in our version. So we built governance from the ground up. We didn't fork anything. Ours is called the 2-token governor. It has 2 tokens instead of 1. One is like a high-level emergency powers value accrual token, where all of the economics in the system will accrue to this token. And the other is a pure voting governance day-to-day operations token that the only incentive you have to use that is to earn the other token. So what's unique about our system, though, is that we enforce 100% participation. So every other DeFi application, they have this huge apathy problem where nobody wants to vote. And maybe they have 10% of the supply voting, and it opens them up to governance attacks. It opens them up to centralization risk. We just nip that in the bud. So the way ours works is it runs in 30-day epochs. If you don't vote for an epoch, you lose 10% of your tokens. Period. You get slashed, basically. And it's not like those tokens are then distributed to the rest of the token holders. No, they are sold off to the highest bidder, which gives us new blood that's now buying into the system with an incentive to say, I'm going to govern. So this has been very successful. We've had 3 epochs now, and we've had basically 100% participation in every single one of them. So because people don't want to lose their tokens. And what we think is that builds out better governance outcomes. Once you force everybody to the table and you curate that list of people who are there, or you force them to buy in, they're now incentivized to make good decisions because they put skin in the game and they want to see the system work. So we think that's a much better system. And also we have these epochs, which are very important. So we don't force people to constantly monitor the governance. We say you need to check this once a month. And once a month, there's going to be a list of proposals. You have to vote on all of them, but that's all you have to do. We simplify the job. We simplify the types of proposals. So there's only a few things you can do. Our contracts are immutable. You can't upgrade the contract. So there's no debates over smart contract code, et cetera. There's just, do you want to add this person as a minter? Do you want to add them as a validator? Do you want to add them as an earner? And do you want to change one of these basic parameters? And that's it. That's all governance does. So I think our biggest innovation in governance was actually removing a lot of the roles of governance that other DAOs have.
Very cool. So do you think this model, like if I'm holding this token, then like I have to be interested in governance because it's like very focused on only doing that. So if I'm not interested, then I'm not going to do it. So it's kind of like a selection mechanism for people who actually want to do the governance. Is that the idea?
If you're not interested, you're going to have paid for something that you then lose because we're going to take it from you.
Right. Very cool. Yeah, I think a lot of governance tokens, they're kind of like a mix. It's kind of like, am I bullish on this protocol? I might buy, this token. And then it's like, oh, you can also do governance. So yeah, it's a little bit unclear. And
well, that's why we split them too. Like we said, if you want to just be a passive participant in this protocol, buy the other token. And then what you get with that is the emergency power to actually reset the governance token to yourself. So that this is, I'm probably getting too into the weeds here, but like one very interesting about our system is with power and zero, right? Power is like the one that has to vote every 30 days. Zero has no voting obligations, but zero has a very unique power called a reset, where if you can hit a certain quorum, I think we said it's like 65% of the supply or something, you can actually reset the entire power supply to the zero token holders, which is their way of saying, power token holders, you are doing a bad job. We want it to be passive, but we can no longer do that because you were doing such a bad job. So we are now becoming the active governors.
Wow, that's really fascinating. That's
Interesting.
really, really interesting. That is crazy to me. That's
That's kind of like politics almost. There's like different
Well-
levels of government, and
Yep.
they can replace.
well, what it reminds me of, so like, with the Republican system or whatever, going back to Rome or whatever, it's the exact opposite power dynamic, right? Where it's like a person is like empowered to like seize authority and make all the decisions in times of emergency. But this is saying we're going to just flip it back to we're going to re-socialize it to everyone else immediately if we hit a quorum. That's quite interesting. So if that emergency power is activated, are those tokens just redistributed like equitably amongst all the zero holders, or is it like burned?
Pro rata.
Okay.
So what technically happens is we just replace so in our contracts, we have the address of the token that is governing the system. We change that address to a new token and then airdrop that new token onto all of the zero holders pro rata. And this is all done immutably decentralized. Like there's no human intermediation here. This all happens automatically the moment that quorum is hit. But again, I'll be very surprised if that ever does get hit unless something goes heinously wrong, because this token is self-selected to be the passive participants of the system. They don't want to govern. They're only going to put this responsibility on themselves if something's going really wrong.
So I may have also misunderstood, but it was the power token, which is the one you have to vote every 30 days with, is the only way to earn the zero token, or you can just buy the zero token? Or
you could buy the zero token if any of our existing investors sell it, but the only way to earn new zero tokens is to participate in governance.
Okay, cool. So you could think of it as like almost like you can buy it, but it's like you're accumulating seniority, and then like after enough time, you may have enough seniority to say, screw this system, you guys don't know what you're doing. Okay.
Well, another interesting thing we did is we most systems allow you to delegate voting power. We do too. But most of the systems don't offer any on-chain reward for that delegation. They leave that up to like the two individuals to figure out. We actually programmed it so that when you delegate, 100% of the zero rewards go to the delegate. So if you hold power tokens and you delegate them to me and I vote, I get all the rewards. You get nothing.
Wow.
Because the whole point is like you're supposed to be rewarded for voting. This isn't like some sort of voting power that you're supposed to market around to the lowest bidder. All of it should go to whoever is participating.
This sounds so nerdy, but it's been a really long time since I heard something about governance structure that was like, wow, that's really interesting to me. That's a really cool way to do it.
It's a long journey.
yeah, it's a tough nut to crack, dude. I mean, it's like whenever I think of governance, I think this is like I don't know, 10,000-year-old problem. Like how do you get people to make the good decisions on aggregate for the group? But yeah, fascinating. Very cool. I want to kind of turn it back here to the actual, like, I guess, economics, or I guess the business itself. What do you see as like the kind of future of M0? Like, do you expect to get like a Japanese pension fund on soon? Is that like, I'm sure that's like a long-term goal.
Not soon, unfortunately. I think for the near term, like we're just trying to turn existing stablecoin distributors into issuers. So we have 4 very large market makers in our cap table. We just did our Series A. And our goal is to turn entities like that into issuers, because today they're issuing for Tether and Circle and not getting paid anything. So they could switch to our network and they could become the issuer that they're currently distributing for.
Fascinating. Okay. Are there any other like challenges you can see in the near future? Are there any kind of regulatory risks involved here?
This is where being a neutral base layer is kind of beneficial, because we run the first issuer. It's run out of BVI. It meets all of the regulatory requirements there. But there are certain restrictions that come along with it too. Like, for instance, we can't distribute it to the United States. But we do, as a neutral base layer, any issuer can come and apply to be part of the network. And as long as they are meeting the local regulatory requirements, we're fine. So, like, for instance, if we wanted to have a U.S. issuer, we need a U.S. minter to come online and meet all of the U.S. regulatory requirements. So it gives us an opportunity that a lot of others don't have, because they kind of have to pick their home base and stick with it. We get to have a global distributed presence. And it's actually beneficial to the minters because now they get to specialize in different regions and jurisdictions.
I love it, dude. You get that. You're in the perfect spot to decentralize and capitalize on the benefits of it. Do you want to take a question, Ulver?
Yeah, I guess the big picture, like how do you think this will transform the current monetary system, like in the long term?
We think that we are rewriting the way money is distributed. So, like, we're very bold on this. Like, we believe that we are actually going to shake commercial banking to its core, because the way commercial banking works today is very unfair to the consumer. Like, you go to a commercial bank, they give you a deposit, and you use that deposit like cash, meaning that you'll accept a very, very low interest rate on it, but you're still taking on all the risk of the bank's loans. So you're just giving this margin to the bank for no reason. We think that the future looks more like what things used to look like, where average cash and like payment currencies and some savings are held in something that looks a lot more like cash, that isn't going out there and taking long-term loan risk. And then if you're putting your money in a savings account at a bank, it should be compensated as such. So the bank should have a much lower margin on its deposits than it does today. So we think that we're really going to reorder the way that money is distributed in the economy. We also think that crypto dollars or stable coins, whatever you want to call them, are going to power the US dollar in the global economy for the next 50 to 100 years. Like, this is going to cause more demand for dollars than anything we've seen before. And you think about the progression of this, it makes perfect sense. Like, we started out with Bretton Woods and central banks doing dollar transactions over different countries. And then we moved to the petrodollar, which is now denominating international trade in dollars. And now this is the final step of that. We are now going to dollarize domestic economies, which we could never do before, but because we had no way to infiltrate the payment systems of those economies. It's happened in a few places like Argentina, where like the money is just so bad that people are willing to revert to physical cash. But anywhere you wanted to have digitization of money, it's not able to dollarize because their payment systems will block it out. This is now going to have domestic transactions in foreign countries taking place in dollars, which is going to be an order of magnitude of new demand for the dollar itself.
Yeah, I guess nowadays, the dollar is kind of global, but I guess it's the euro dollar system. So you can get dollars, but like from a European bank or whatever bank, but then they have to buy the dollars and they have to get it somehow, like from the Fed. So I guess this would kind of like further globalize the dollar, so it's like an actual global system.
Well, the point is that right now it's all at the periphery, right? So if you're looking at two countries that are trading back and forth, they're probably all the domestic transactions are in their local currency, and then the international transfers denominated in dollars. And there's like a point where they exchange. What we're envisioning is like those domestic payments even turn into dollars. So when you are in a foreign country buying a coffee, today you're using the local currency. In 10 years, maybe you're using a stablecoin that's $1.
Yeah.
Oh, wow.
This is huge.
Like, is this bearish for my Swedish crowns?
Unless Sweden just overregulates as always and bans all the dollar stablecoins.
Yeah, I suppose that is the risk, right? Is that because of the implication of that kind of infiltration, I guess, of domestic economies, you would have extreme protectionist measures arise. But there is something just as we know with crypto that's kind of like it's difficult to weed out. It's really hard to really strongly enforce it because of its permissionless nature. You have to be like China, Great Firewall, but even then, very difficult. Yeah, I mean, I kind of want to talk a little bit more about what you think that world would look like. Because it's been on the forefront of my mind for a while. Like, what does it actually mean for international like monetary policy with the further integration of crypto? Because one of the realities of like the dollar system, and everyone talks about it, right? Everyone gets all excited about BRICS, where it's like you have like these economic or political blocks that form because the petrodollar, the United States has like a lot of political and economic tools at its disposal to get what it wants done in the world and to enforce its will. Would this empower it, you think, or would it depower that ability to manipulate people? I mean, or nations and policy? That might be like too broad of a question, but
I think it's actually two questions
mm-hmm.
packaged into one. So like there's the political component and then there's the economic component.
Mm-hmm.
I be honest, I don't know about the political component. That's like a whole that's out of my realm of understanding. But the economic component, I think the government's very much going to like stablecoins because they're already one of the top holders of U.S. Treasuries. And, I don't know if you've noticed, but we like to spend a little bit more than we make here.
Yeah.
And we have pretty large deficits. And the way we finance those deficits is due to this excess demand for the dollar. So if we can even increase demand for the dollar beyond what it is today, it gives the government like kind of an escape hatch to finance those deficits for a little longer until we can get our fiscal house in order. So I think the government's going to be a big ally of stablecoins going forward and hopefully start actually pushing them politically overseas.
Hell yeah, Greg, we got to get you in front of Congress, dude. You got to tell them this because they'll love the idea that we can increase the credit limit on their card here, the Treasury.
I really think that's the promise of stablecoins. Like that's been the petrodollar was one of the greatest deals ever made because it let us finance these absurd deficits for like 50 years, and that seems to finally kind of be at the tail end there of what people are willing to tolerate. But if you 10x demand for the dollar, we can have 2% interest rates again and do it all over.
Hell yeah! Well, I'd love that. I know we're kind of like pushing up against the hour here, but do you have like another couple like minutes? Because I have a couple other Ulver and I have a couple other questions. A little bit more on the personal side. I think we kind of covered where M0 came from, where it is, and where it's going. But I like these two questions here. What are some of the biggest challenges you faced as a founder in crypto, and how have you overcome them? We're two enterprising young guys. We want to be successful too. What's the secret?
Biggest challenge as a founder in cryptos. I mean, I don't know if anything is crypto specific as a founder. Mm-hmm. And I guess like you probably have a little bit more difficult of a time opening a bank account.
Yeah,
but that's good for us because we sell an alternative. I think the biggest challenge as a founder is like the lack of stability and like the constant need for more work. Like there's just always more work you could do, and you need to kind of limit yourself to stop. Like you see your friends and they have these very stable long-term jobs now, and they it's a simpler life. Like whereas I wake up every day, there's a lot of uncertainty, there's a lot of intensity. But at the same time, that has a tremendous benefit if you play your cards right. So I don't think I trade it for anything, but it's different. It's a different lifestyle.
For sure. It is quite invigorating, right? I mean, it's harrowing and invigorating, right? Like it's scary when you wake up, market's down 50% across the board. But it is also, kind of fun, like that you live and die by, what you catch, right? Because I got a friend he's got a railroad pension. I don't know if you're familiar with those. They're like very old timey. They don't even think they issue them anymore. But he's like trapped now. Like he can't leave or else he loses it. So very different problem. Yeah. So do you have any advice you'd give to people looking to innovate in blockchain and crypto now, like looking to start out?
Like I would say, please, for the love of God, stop building the same thing over and over. We don't need any more infrastructure. Like, we need a consumer facing application. I'm putting my money where my mouth is. Like, I think the only successful consumer application we've had besides Bitcoin itself are stablecoins. So, but we need more. Like there's so many things that we've been talking about building in the space for years now. The infrastructure is now there. We don't need any more of that. Please build the consumer apps.
Yeah, please get the consumer involved. I think that's good advice. Ulver, are we building a consumer application?
Well, I mean, now I got some ideas here for some apps. I think, this could be used for, like, I guess fintech apps could build on this. And, they could get the treasury bill rate. And like if you could offer people like come deposit here in a savings account and they're getting a higher rate than all the other apps, then maybe that's like a no-brainer.
Well, that's our dream, right? Like we want to go to not to the US because like you don't need this in the US, but in other countries where they don't really want to save in the local currency. If they could have an app where they have a USD balance and that USD is held behind the scenes in M and it pays them the T-bill rate, I think everybody gets what they want in that situation.
Oh, yeah. Lots of countries like that, too. That's a pretty huge market. And countries that are not necessarily unproductive just have really bad monetary policy. For instance, like Turkey or Argentina. Yeah, dude, that's really hot, dude. Over, we got to fly to Argentina, dude. We got to meet some contacts down there. We'll hook you up, Greg. We'll loop you in on this.
Yeah, fun fact, Argentina prior to DeFi Summer was MakerDAO's biggest market for DAI. Like you could go to Buenos Aires and there would be grandmothers that were holding DAI.
That's awesome. Yeah, I mean, it makes sense too. They have all the infrastructure necessary to access and, the education and know how to do it. Just really, really unfortunate policies that they've been flip-flopping between for the last 100 years. Awesome. Any final thoughts, any final questions, Ulver, and then we'll turn it to final thoughts.
Yeah, how can our listeners get involved with this and to learn more about the protocol?
Yeah, so they can go to m0.org for all the informational needs they might have. And then for getting involved, we're really starting to ramp up and roll out now. So we are launching on many blockchains. We're already on Ethereum mainnet. We've got like 30 million in TVL, and that number should hopefully grow very fast from here. And we're planning to go to a bunch of different ecosystems. So I would say for them, if they like the product and they feel like it's something they want to hold, they'll be able to go out there and use it. But also if they see an application where it would make sense, tell us, because we will do the work to get it integrated.
Yeah, definitely. We will do that. We'll put the link in the description so people can go check out the page directly. So if you meet anybody in the Argentinian Central Bank or something like that, send them Greg's way. Any final thoughts, Greg? Anything you want the audience to know before we sign off completely here and let you go? We free you.
Just please give us a follow on socials and watch what we're doing because I think you're gonna be happy.
Awesome. Yeah, I'm already happy with what I'm hearing. So, thank you so much, Greg, for showing up and filling us in, dude. This was very informative, really interesting conversation. Thank you, Ulver, for being here as well.
Yeah, thank you. It was very exciting. I see a lot of potential here.
Yeah, thanks for having me, guys.
Awesome. And thank you all for watching, and we'll catch you next time. Bye-bye.